Hi everybody, it's AJ speaking. Just want to give you a quick update on interest rate cut expectations. The data that you see is based on the probability weighted expectation as can be inferred from futures pricing. This is particularly interesting because this is a market that is, I should say, this is a market segment that is populated by quite sophisticated investors and therefore tends to provide a stronger signal than, for example, equity markets. And just a real quick recap how this chart works. Here on the y-axis, you see the basis points, the current level of interest rates marked with this horizontal red line. So we are right now in the range of 425 to 450 basis points. The line is put at the midpoint of that range. And then all of the other horizontal lines, but in a dashed manner, indicate one interest rate cut, so one 25 basis point step from the current level. Then these vertical lines show you the next four FOMC meetings, i.e. the decision point. So the next meeting is on September 17, and it also shows you the latest FOMC meeting, which was on July 30th. So a first key observation, so for the next meeting, the one in September, market is right now mostly at one cut. You can see this by looking at the screen line. The screen line is very close to this first dashed line, indicating one cut. And then this blue line, this dark blue line, the line for the October meeting, is right now between 1 and 2 cuts. And it's a bit hard to see because there's some overlay of these lines. This lighter blue color, that's the third line basically. That's the line for the third meeting from the current perspective. That's the December meeting. And for that meeting, the market is right now between 2 and 3 cuts. And then for January, you have this purple line, and this purple line is mostly near 3 cuts. Again, this is probability weighted and is mathematically derived from pricing. However, even though there's a very robust methodology behind this, it doesn't mean they are good predictors. And we can see this very clearly when we look back at what happened historically. So the chart you're looking at right now shows you for the last 6 meetings, the expectation, how it developed over time. So, and the lines obviously stop at the respective lines for each meeting obviously stop at the point when the meeting occurred. That's why, for example, this dark blue line, that's the line for the December 2024 meeting, ends in December 18th, 2024. The most recent meeting is the line here in this brown color, and that meeting was on July 30th, and that's why the line also ends there. And also the chart ends there because that's the most recent historical line we have. Just high level, when you first look at this chart, the key thing that you can take away from this is that number one, far out expectations have significant volatility. The market both significantly overestimates rate cuts, but also significantly underestimates rate cuts. For example, if we look at the most recent FOMC meetings expectation, so the one end of July, interestingly, we started off when we first got data to derive this curve last year in July. The the probability weighted expectation was not too far off from the actually later announced rate, i.e. no rate cut. As you can see here, this brownish line is not too far off from this horizontal line, which indicates the current interest rate level. But then the market completely got it wrong, and just a few months later, priced in almost 6 cuts by July this year. I repeat, the market was only 11 months ago off by 6 rate cuts, almost 6 rate cuts. But then also, if we look at the curve that ended in December 2024, the market at around May 2024 priced in 3 notches higher interest rate level, almost 3 notches. You can see this here at this peak. So even though this market, this interest rate market is comprised of quite sophisticated investors, and they too really struggle to forecast interest rates. So I think the key lesson to take away from all of this is that it's best to have some humility, that interest rates tend to be mostly wrong, or the expectation tends to be mostly wrong, even amongst a group of people that has a huge motive, financial motive, to get this right. So now if we go back to the current outlook, despite rates not moving very much, i.e. interest rate level didn't change, the market keeps rallying. Fundamentally, lower rates would be good for the market, but obviously there's the issue of inflation. And actually, in just about 2 hours, we get the next inflation readout. And core CPI, that is the key number, is expected to come in at 3%. And that is still significantly above the target rate of 2%. So the bottom line is, when you look at these next 4 meetings and the track record of these expectations, it's quite likely the market got it wrong yet again. I think we need more progress on the inflation front before we actually see rate cuts come through. But the other part is obviously the employment market, and we just got a couple of days ago a significant downward revision of the jobs report, and that was actually that caused shortly after the FOMC meeting this significant drop in these curves. And just to be clear, when the curve goes down, that means the expectation for interest rate cuts goes up. So this green line for the September meeting dropped from trending towards no cut, quickly dropped down to clearly one cut. So anyways, I'm quite excited about the CPI report just in 2 hours. And as usual, I will go through it in detail and will share my thoughts. Thanks for listening. See you in the next one. Bye.